like to own a slice of a business that rakes in billions of dollars in profit? Want to collect a big fat dividend while owning that slice? Like the idea of investing in a business that actually stands to benefit from the current health crisis? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a thumbs up if you find value in our videos. This helps us to get the word out and grow the channel. I'd really appreciate it. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing the world with pharmaceutical products that are helping to improve, prolong, and save lives. It's so important right now to be careful about the industries you're investing in, as some are getting hurt more than others. But this business actually stands to benefit from the pandemic by virtue of their vaccine work. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Pfizer Inc., which appear to be trading at a significant discount today. Pfizer Inc., stock ticker PFE, is a global pharmaceutical company that discovers, develops, and manufactures a range of healthcare products. Founded in 1849, Pfizer is now a $187 billion by market cap healthcare giant that employs over 88,000 people worldwide. Approximately 46% of sales come from the US, with the remainder being from international markets. Pfizer has a broad portfolio of drugs, including blockbusters like Ibrance, Equilus, Xeljanz, and Lyrica, all with over $1 billion in annual sales. The company also has the Prevnar family of vaccines. All in, the company has 8 brands with over $1 billion in annual sales. Pfizer also maintains an impressive pipeline through its R&D. As of April 2020, they have 21 compounds in phase 3. And via a partnership with BioNTech SE, they're aggressively attempting to develop a vaccine for the current coronavirus pandemic. If we take into account the recent or soon-to-be spin-offs, Pfizer will be moving forward primarily as a global biopharmaceutical company with a focus on branded drugs. Toward that end, Pfizer completed its joint venture with GlaxoSmithKline plc in August 2019. This JV saw Pfizer merge its former consumer healthcare segment with GlaxoSmithKline's consumer healthcare division. Operating as GSK Consumer Healthcare with products like Advil and Centrum, this is the world's largest OTC products business. Pfizer owns 32% of this JV. In addition, Pfizer announced that it plans to spin off and combine Upjohn, its off-patent, branded, and generic established medicines business, with Mylan NV, creating a new global pharmaceutical company called Viatris. Structured as an all-stock reverse Morris trust transaction, Pfizer shareholders will own 57% of the combined new company. It's expected that Pfizer shareholders will get 0.12 shares of the new company for every 1 share of Pfizer that they own. This transaction is expected to close in the second half of 2020. Healthcare is one of the few industries that's clearly fit for long-term investing here. The need for treatments doesn't suddenly disappear. If anything, major healthcare firms like Pfizer stand to benefit from the current situation. Their vaccine work is evidence of that. This bodes well for the firm's ability to continue growing its profit and its dividend. As it stands, Pfizer has increased its dividend for 10 consecutive years. The 10-year dividend growth rate is 6.1%. That's solid when you pair it with the 4.5% yield the stock offers right now. This yield, by the way, is 100 basis points higher than the stock's own 5-year average yield. And with a payout ratio of 54.3%, this is a well-covered dividend with plenty of room for future dividend raises. Looking at business growth, Pfizer's revenue is down from $67.809 billion in fiscal year 2010 to $51.750 billion in fiscal year 2019. I never like to see a revenue decrease. However, this decrease is due more to various restructuring moves than any kind of issue with Pfizer's core business model. Besides the aforementioned JV with GlaxoSmithKline, there was also the spin-off of pets and livestock medicine and vaccinations maker Zoetis Inc. in 2013. For further perspective on that, Zoetis is now a $65 billion by market cap business. This spin-off reduced revenue, but Pfizer offered a share exchange that reduced its net outstanding share count. If we look at profit on a per share basis, we can see that Pfizer increased its earnings per share from $1.02 to $2.87 over this 10-year period. That's a compound annual growth rate of 12.18%. Pretty impressive stuff, but I will say that Pfizer's messy decade makes it somewhat difficult to get a clear picture of their growth. Helping to fuel much of that EPS growth has been buybacks. Pfizer's outstanding share count is down by almost 30% over the last decade. That's a very large reduction. Looking forward, CFRA projects that Pfizer will compound its earnings per share at a 6% annual rate over the next 3 years. CFRA cites increased generic competition for Lyrica after the loss of exclusivity, as well as a drop in Chinese sales for Lipitor. Indeed, Pfizer's Achilles heel is a patent cliff. Many of their drugs are coming off patent over the next few years, including Chantix in 2020, Sutent in 2021, and Ibrance in 2023. Cancer drug Ibrance is a blockbuster that comprises approximately 10% of Pfizer's sales. Offsetting some of this is the company's deep pipeline supported by big R&D spending, which was $8.7 billion in 2019. And its decision to focus on branded drugs after the upcoming spinoff could improve the pipeline further, resulting in even more growth. I view CFRA's near-term EPS growth projection to be fair. Between a recent buyback halt and the patent issues, Pfizer won't knock you dead with growth, but a 6% EPS growth rate would support like dividend growth over the coming years. And pairing that kind of growth with a 4% plus starting yield is compelling in this environment. Moving over to the balance sheet, Pfizer maintains a rock-solid financial position. The long-term debt-to-equity ratio is 0.57, while the interest coverage ratio is north of 11. Furthermore, they have almost $10 billion in total cash. Admittedly, the balance sheet did look better 5 years ago. There's been some mild deterioration here, but it's simply moved from a great balance sheet to one that's somewhat less so. Profitability, meantime, is spectacular. Over the last 5 years, firm has average annual net margin of 15.82% and annual return on equity of 19.34%. Pfizer has all the makings of a great long-term investment. It's a world-class pharmaceutical company that's about to reorganize into something even more focused and profitable. And durable competitive advantages like patents, inelastic demand for products, R&D, massive scale, technological know-how, and global relationships all serve to protect the company. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. I think all three of these risks are elevated in the pharmaceutical industry. The pipeline is strong, but the company's near-term patent cliff is substantial. And although the new focus on branded drugs is exciting, there's still a lot of uncertainty regarding the upcoming spinoff. Overall, there's a lot to like about this dividend growth stock. It's even more likable when the valuation is attractive, like it appears to be now. The stock is trading hands for a PE ratio of just over 12. That's significantly lower than the broader market. It's also much lower than the stock's own 5-year average PE ratio of 21.9, although it's difficult to make this comparison because of volatile GAAP earnings. Every basic valuation metric shows cheapness against recent multiples. The price to cash flow ratio, for instance, at 13.6 shows a disconnect against the 3-year average of 14.3, and the yield, as noted earlier, is meaningfully higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 9% discount rate to account for the high yield and a long-term dividend growth rate of 5%. That dividend growth rate is on the low end of what I normally allow for, but I think this kind of conservative stance is warranted in this case. The patent cliff is material, and both the 10-year proven dividend growth rate and the near-term earnings per share growth forecast from CFRA are in that 6% range, which doesn't promote enthusiasm for anything more than mid-single-digit dividend growth from here. That said, this is setting the bar pretty low. There's not much of an expectation here, so it wouldn't take much of an effort for Pfizer to surprise to the upside. However, I'd rather err on the side of caution. The dividend discount model analysis gives me a fair value of $39.90. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividend and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates PFE as a 5-star stock with a fair value estimate of $42.50. CFRA rates PFE as a 4-star buy with a 12-month target price of $41. I came out the lowest, but we're all in the same neighborhood. Averaging the three numbers out gives us a final valuation of $41.13, which would indicate the stock is possibly 22% undervalued. Here's the bottom line, guys. Pfizer Inc. is a high-quality pharmaceutical company that's about to shift into something even more focused and profitable. With a massive yield of 4.5%, solid dividend growth, a moderate payout ratio, and the potential that shares are 22% undervalued, this looks like one of the better long-term opportunities in this market for dividend growth investors. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did. Also, let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. And take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from the same exact stocks that I own. If you think this is something that you could benefit from as well, check out the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.